What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. Over the past decade, China has experienced something of an economic miracle, with their GDP more than doubling to $15 trillion. When adjusted for purchasing power parity, they have already surpassed the US to be the largest economy in the world in absolute terms. However, this growth has not come without its costs. During this same period, the country's debt to GDP ratio has doubled to almost 300%, making it one of the most indebted major economies. Much of this debt has come from private companies such as Evergrande, which took on excessive leverage while real estate prices were booming. But the government has played an equally important role in fueling the debt-driven growth. Over the past decade, the government has invested hundreds of billions of dollars into the world's largest high-speed rail network. This has boosted GDP statistics and created millions of jobs. However, their obsession with high-speed rail has led to billions of dollars of financial losses and hundreds of billions of dollars of debt for state-run rail companies. China's high-speed rail binge has been massively inefficient. For example, they spent over $20 billion to build an 1,800-kilometer line to the remote Xinjiang province. It is currently operating at roughly 6% of its break-even capacity. The state-run China Railway Group is losing tens of billions of dollars per year and has racked up a whopping $900 billion in debt. This is roughly 3 times the size of Evergrande's liabilities. Things have gotten so bad that the government was forced to halt 2 previously planned high-speed rail developments earlier this year. Today we'll look at the economics of China's high-speed rail, why it's losing so much money, and whether this will pose systemic risk to the Chinese economy. But before we get into this video, a quick word from our sponsors at Masterworks.io. It's no secret that stock market valuations are near all-time highs with their cyclically adjusted Shiller price-to-earnings ratio currently at levels not seen since the dot-com bubble. Stock market valuations have been pumped up by record money printing by central banks around the world. This has also caused consumer price inflation to accelerate to 6.2% in October with no signs of slowing down. This puts the stock market in a very vulnerable position, as the Fed may be forced to tighten monetary policy. This could crush the multiples of high-growth tech stocks. Legendary investors including Ray Dalio have said they expect below-average stock market returns and heightened risk given how high valuations are. But at the same time, you don't want to own cash, which is all but guaranteed to be degraded by inflation. In light of the current market environment, sophisticated investors have been increasing their allocations to alternative asset classes, including fine art. But why art? For starters, the Wall Street Journal just called the art market to be among the hottest on earth, with works selling for 15 times their asking price. In fact, 2/3 of billionaire collectors allocate between 10 and 30% of their overall portfolios to art. Contemporary art prices have outpaced the S&P by 174% from 1995 to 2020, which is incredible considering the historic bull run over that period. And according to Citibank, it has the lowest correlation to the stock market of any major asset class and is shown to outperform during times of inflation. But up until recently, ordinary investors have been shut out of this asset class because the prices are simply too unattainable. This is where our sponsor Masterworks comes in. Masterworks.io has emerged as the only platform taking billionaire art collectors head-on and lets you access their exclusive investments. Simply put, you can now invest in the very same art that billionaires do, by names like Banksy, Monet, Basquiat, and other iconic artists just for a fraction of what they pay to purchase. All you need to add these assets to your portfolio is to simply visit Masterworks.io, create an account, browse their latest artwork, and invest in any of their current offerings, just like how you would trade stocks on your smartphone. From there, you can either hold your shares until Masterworks sells the painting, or sell your shares on their secondary market. Investors already received a 32% annualized return from 2020 from their sale of Bansky's Mona Lisa. If this looks interesting to you, you can sign up to open up a Masterworks account with the link in the description below. Over the past 30 years, China has urbanized rapidly, with hundreds of millions of people moving from rural areas to big cities. Since the 1990s, they have invested hundreds of billions of dollars to develop the world's largest and most sophisticated high-speed rail, or HSR, network. The goal of this was to facilitate urbanization and economic development. HSR trains can travel at speeds exceeding 200 miles an hour and can transport passengers across the country in a matter of hours. They offer a superior value proposition to domestic consumers, as they're almost as fast as air travel but at a fraction of the cost. In the early days, the HSR lines they operated were economically feasible. They had high utilization and most of them were profitable. But this all changed during the global financial crisis of 2008. As financial conditions froze up, China's private sector contracted rapidly, with widespread bankruptcies and unemployment. In response, the government went on an extremely aggressive public infrastructure campaign to create jobs for their HSR development by spending tens of billions of dollars every year to open new lines. The problem with endless government infrastructure projects is that they exhibit diminishing returns to scale. They started off with the most highly trafficked routes, connecting major cities such as Beijing and Shanghai. Given how high the population density is, the trains are almost always full and they can more than pay for themselves from the ticket fares. But eventually, you get to the point where you've already connected all of the major cities. From a financial perspective, this is where you should say mission accomplished and stop building new lines. But by this point, new HSR construction was a critical part of China's economic growth engine. The state-run China Railways directly employs roughly 2 million people. They also employ hundreds of thousands of additional workers indirectly through their suppliers and contractors. This contributes hundreds of billions of dollars to GDP. Slowing down new construction would necessitate hundreds of thousands of layoffs and likely plunge the economy into a recession. China's top-down economic model incentivizes government officials on both the national and local levels to meet high GDP growth targets every quarter. And one of the easiest ways to do this is by building more and more government infrastructure projects. The desire to boost economic growth figures have pushed the state-run China Railway Group to build HSR lines that are not even close to economically viable. The most obvious case of this is the Lanzhou-Xinjiang HSR line. It was constructed between 2009 and 2014 with a total cost of more than $20 billion. Xinjiang is one of the most sparsely populated provinces in western China and is also home to the country's minority Muslim population. There is relatively little travel between Xinjiang and the more heavily populated areas on the eastern coast. You can think of this project as the rough equivalent of building a train line from Detroit to Wyoming. It doesn't make a whole lot of sense. It's been in operation for almost 7 years now and has lost money every year. There simply isn't enough demand from travelers. It is currently estimated that the line has just 6% of the capacity utilization that it would need to break even, let alone ever make back the $20 billion of investment. The government says they never intended to make money on the project. Its primary purpose was to increase social and economic integration of the Xinjiang minority population with the rest of the country. But given how few people are actually using this line, it's hard to see how it could succeed even on that measure. While the Xinjiang line is the most extreme example, most of the HSR projects that China has taken on in recent years have been big money losers. The decades of building new, unprofitable railroads have taken a serious financial toll on the state-run railroad company. As of the end of 2019, China's state railways had 5.5 trillion yuan, or roughly $850 billion in debt. This number increased to $900 billion by the end of 2020. For the first half of 2021, they made a net loss of $8 billion, despite rail travel recovering almost all the way back to 2019 levels. In fact, these numbers actually understate the total level of debt. About half of the costs associated with railway construction are financed by local governments. So the total level of railway debt is probably closer to $2 trillion. This has led to deteriorating balance sheets of local governments across China. A recent report by Goldman Sachs estimates local governments' debt to be $8.2 trillion, or more than half of GDP. Having already spent so much money on railroad development, many Chinese municipalities are struggling to fund the more mundane expenses such as schools, roads, and local police departments. And the losses will probably only get worse. Pretty much all of their new lines are unprofitable, so the more they grow, the more money they will lose. The Ministry of Finance will just have to lend them more and more money to pay off their old debts and keep building more trains. China has been investing more than $100 billion per year in railway infrastructure since the 2008 recession. This has led to a situation where 2/3 of all high-speed rail in the world is in China. This has been great for boosting GDP numbers. In fact, when adjusted for purchasing power parity, Chinese economy is in fact bigger than the US. But a significant portion of this GDP is created by government railroads that very few people actually use, or speculative real estate development projects in the private sector. The only way to sustain their breakneck pace of growth is to continue building more and more train lines to Xinjiang and Tibet. It technically boosts the economic growth statistics, but it doesn't really do anybody any good. And it is not sustainable because eventually the economy will collapse under the mountain of debt. The government knows this, and they have been making some efforts to slow down credit growth in the economy. That's why they implemented the 3 red lines policy for real estate developers last year. This ultimately triggered the Evergrande collapse. They've also started slowing down investment in high-speed rail for the first time in many years. There are 2 types of economic growth, secular and cyclical. Secular growth is driven by technological innovation, which increases productivity and creates real value for end consumers. This is happening in China with innovative technology companies and electric vehicle companies like Alibaba and NIO. Cyclical growth is the inflation of debt-fueled investment bubbles in private real estate or public infrastructure. Cyclical growth has been the main driver of China's economy over the past decade or so. President Xi now faces a tough balancing act. He is trying to gradually deliver the Chinese economy. That's why he's refusing to bail out Evergrande and gradually scaling back on high-speed rail development. But at the same time, he doesn't want to cause a painful recession with high unemployment. With dozens of major property developers in major distress and $900 billion in debt in the state-run railroad company, he certainly has his work cut out for him. Alright guys, that wraps it up for this video. What do you think about China's high-speed rail? Do you think the excessive debt could cause further distress in the Chinese economy? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.